I'm Tim Kraus and I approve this video, even if I might not know what I'm talking about. Quick question for you. In your client review meetings, have you ever come across old whole life policies that have outstanding loans on them? I'm guessing that most of you have, and here's why. First of all, whole life insurance historically has made up a large percentage of the overall market of life insurance sales. So there's a lot of policies out there in the households of clients that you're meeting with. And the second reason is there's actually multiple ways that loans can end up accruing on a whole life policy. The first is obvious. The client needs the money for whatever reason. They call the carrier, they request the money, the funds are loaned out. But the second one is something that maybe not everybody is aware of, in that a lot of whole life policies require premium payments to be made consistently for the policy to remain in force. And if a client misses their premium payments, there can actually be a loan made against the policy to pay those premium payments, and that loan balance starts to accrue without you or the client maybe even realizing it at first. So why does this matter? Well, whole life policies with loan balances out do have a potential lapse problem for a couple of reasons. One is if you look at dividend rates going back maybe to the early 2000s till today, some of the major whole life insurance carriers have dramatically decreased their dividend rates that are being paid out on the policy. So they're not necessarily performing as expected. The other reason is loan interest rates. Historically are 6, 7, 8%, pretty high compared to today's loan interest rates. So once a loan balance starts to accrue, because of the high interest rates, it can really have a dramatic effect on the policy. So what happens if a policy does actually lapse? Why are we talking about this? Well, there could be potentially really harmful tax consequences to the client. If there's gain in the policy and there's an outstanding loan when the policy lapses, that loan balance could potentially be taxable to the client. So you're talking about, whether the loan balance was for missed premium payments or money that they took out of the policy 5, 6, 7, 10 years ago, and now they have to pay taxes on that money now. Yuck. I wouldn't want to be in that situation. So what can we do about it? Well, there's really three options. One is the client can do nothing. They're likely going to face that scenario that I just talked about. Two is they could pay that loan off, which more power to them if they can, but you're talking about continuing to make the premium payments and making additional payments to pay that loan balance off. Might not be a realistic scenario every time. So what's the third option? Well, that's where we can help you out. If we take a look at the policy and it fits, they could potentially 1035 exchange that policy into a new one and mirror that loan balance over to the new policy. And in some scenarios, they don't have to pay the loan off. They might even reduce their premium payments. They might even increase their guaranteed death benefit. And most importantly, they avoid the situation of the policy lapsing and having those tax consequences. So if this is a scenario you face and you want more information about how we can help you with it, shoot me an email. My email address is likely coming across the screen, maybe here or here. Not sure where it's going to be yet, but email me. I will send you whatever information you have out of these options. I've got a one-page flyer that's got more detailed information on these scenarios. I've got an actual marketing piece that you could send out to current clients or potential prospects. And then I've got some more information on some actual case studies where we've worked on these cases and 1035 to exchange the policies for new policies and how that all worked. So shoot me an email. I'll get you some more information.